Welcome to this week's episode of Financially Speaking. As a local family-built firm, Bushka Retirement Solutions, along with its affiliate companies Bushka Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Bushka is president of Bushka Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Bushka Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
In this segment, we're going to turn our attention to some of the things you should do before a spouse passes away.
Today, I want to talk about making charitable donations from your IRA.
Today, Ryan and I are going to talk about the Tax Cuts and Jobs Act.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Cole and Ryan with Bushka Retirement Solutions and Bushka Wealth Management. We're going to be talking about preparing for retirement, but if you're interested in seeing one of your questions answered in a future episode, please email us at info@retirewithbushka.com. Thank you both for joining me today.
Definitely.
In this segment, we're going to turn our attention to some of the things you should do before a spouse passes away.
Sure.
So Ryan, how about we start with you? What are some of the things I should do before my spouse passes away?
If you have an inkling that a spouse may be passing away soon, like perhaps if they have a terminal illness or they are quite ill, one of the first things you're going to want to do is to make sure all of your legal documents are in order, as far as making sure things like wills, if you have a trust, that is laid out appropriately for both of your wishes. Also making sure that perhaps if you're the one who hasn't necessarily been in charge of finances or haven't been the primary person there, that you do sit down with whomever you may be working with so that you have a firm grasp. In a perfect world, we want both spouses to be involved in that process. But what can happen in many cases is that one spouse takes the lead in that regard. And so if you're the one who maybe hasn't necessarily been in the lead, it is important that you get a good understanding of what your situation looks like, what life after your spouse might look like, the particular things that you may need to take care of, because everyone's situation is going to be different, to make sure that while you are going through that grieving process, that also doesn't lead you into some type of financial hardship.
Right. And I think that particular tip applies to really everyone. Whether you're fearful of your spouse passing away in the near future or not, I think one of the things that we see very frequently, especially working in this industry for over a decade now for me, is I've seen a lot of clients that have passed away and their spouse is left in this situation where they have no idea what's going on. And unfortunately, often enough, it is the wife that doesn't intimately know all of the financial decisions that have been made and all of the different plans that they had in place. And if they've never been actively involved in that planning process, they may find themselves dealing with the ramifications of decisions decisions that were made that they didn't have direct involvement in. And so we try as much as we can to empower all people to make sure that them and their spouse are at the very least understanding of where their accounts are, have a basic understanding of how they work. And obviously, especially in a situation where maybe your spouse is more of a do-it-yourself investor, I've had a lot of clients that have actually created relationships with our firm because of the fear of what might happen if, let's say, the husband or wife who manages the finances right now unexpectedly passed, leaving their spouse to try to pick up the pieces without that intimate knowledge or the financial background or acumen to be able to know how to handle those accounts without guidance. So obviously, that's one of the additional advantages of working with a financial professional is at the very least, you know that your spouse post your passing is going to have someone that they can reach out to and get that meaningful guidance that they need so that they don't make an emotional decision during that grieving process that could have ramifications well out into the future.
So as you're reviewing all of those important documents, the financial statements, the account paperwork, why is it important to look at the beneficiaries particularly?
Well, because sometimes we don't realize when our circumstances change that we may have to also update documents to go along with that. I mean, life is unpredictable. There could be divorces, there could be all sorts of different things. And if you're not regularly reviewing those beneficiary designations, then at any given time in the future, they might not currently reflect your wishes. And some people think that if they update one document that unilaterally covers everything. They think, oh, I updated my will. And so now I've taken my, let's say ex-spouse out of my will, so I don't have to worry about any of my assets going to them. But let's say you forgot to update your 401k beneficiary designation and that still lists your former spouse. Well, they may wind up receiving that account if you haven't updated that beneficiary document before you pass away. So you want to make sure that you're regularly reviewing those things, taking a look at them and making sure that they still reflect your current wishes.
So you said regularly, Cole.
Yeah.
How frequently is regularly?
Well, that can vary depending on the circumstance, but that's something that we go over with clients in almost every review.
Yeah.
Just going over, has anything changed in your circumstances or in your family circumstances or in your beneficiary circumstance that means you may want to take a look at this or make changes? Now, we generally review with our clients, approximately every year. Some folks don't necessarily always do that type of review, right. like you were talking about. The most common one is going to be the former spouse that, on your 401k plan, which you're probably not reviewing with your 401k provider every year. Right. You might have left that on, 5-10 years after the divorce was finalized and just never gone back and changed it because, beneficiary updates aren't necessarily the most exciting thing to do.
Yeah.
So, of course, anytime that you're going to have circumstances that dictate you should review it, I would, but if you're working with a financial professional, they should be asking you these questions in any type of review. Hey, has anything changed in your circumstance? Because if we don't actively think about it, it's not something we might necessarily just go out and do of our own accord without ever having someone reminding us, hey, have you looked into this? Have you checked on this? Has anything changed?
Right.
Something that's always going to be back of mind otherwise.
Mm-hmm. Yeah, and I mean, even just making sure that there's a beneficiary there, it might not even be that it's listed to the wrong person. It might not be listed at all. I actually personally experienced that just recently. I'm working on my estate plan with my attorney, and one of the things that they posed is go in and, print off all your beneficiary designations. And I looked at my 401k and I had no beneficiary designated on my own 401k. I'm like, well, maybe I should update that, obviously. So looking at those things periodically can catch those little mistakes because, unexpectedly, if someone passed away without a direct beneficiary designated on their 401k, that could mean it goes through probate. There could be other complications that come along with that, especially if you don't have a will or any other estate planning documents in place, which a huge segment of the American population doesn't have estate planning documents in place, which we preach about constantly. And now we can help clients to complete those services through our firm. But obviously, if we never took the time to take a look at it or get those documents in place, it could cost extra time, extra money for our beneficiaries. And again, we might not be controlling where we ultimately want those funds to wind up. So it's important for us to just take a look periodically. And obviously, working with a financial professional can help to remind us when it might be a good time to take a look at those things.
Yeah, and can you talk a little bit about why it's important as you're thinking about that estate transfer.
Yeah.
You have to inventory both your physical and non-physical assets. Can you talk a little
Absolutely.
bit about that?
Yeah, I mean, not everybody is as intimately familiar with your possessions as you are. And so having a listing of not only, your personal property and what you wish to happen to that, but also, inventory your financial accounts, bank accounts, even things like credit cards, so if something happened, your beneficiaries are going to know who to contact to let them know that you've passed away and to know how to deal with those accounts. Making a list of things like subscriptions, that could be another thing. We want to go through and cancel those subscriptions, obviously, if something unexpectedly happens. So just having those tangible and non-tangible things listed somewhere, ideally kept with your estate planning documents, or like our clients can keep that in their generational vault so that it's easily accessible for their beneficiaries to log in and see all of those different items in there. The vault obviously shows them all of their accounts and life insurance policies and all of those types of things. So it kind of simplifies that process a little bit for our clients, but obviously they have to do the due diligence to make those lists of other personal property that we might not be managing on their behalf, so that we can make sure we can guide their beneficiaries as well as possible.
That's great. Well, Ryan, Cole, thank you so much for answering all of my questions today.
Of course.
And thank you for joining Financially Speaking. Stay tuned for more after this.
Close your eyes and picture retirement for a moment. What does your dream look like? Would your days be filled spending time with family and friends? Maybe you desire to volunteer or work a rewarding part-time job. Or do you envision traveling the world? Whatever your dream consists of, Bushka Retirement Solutions can help you realize it. Call or go online to schedule a complimentary consultation today.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Logan Waller from Bushka Retirement Solutions and Bushka Wealth Management. Today, I want to talk about making charitable donations from your IRA. Donating to a charity directly from your IRA is a financial step that doesn't always get a lot of publicity, but a U.S. News and World Report article titled "How to Donate to a Charity from Your IRA" shows why it may be a good option for some people. A qualified charitable distribution is an IRA withdrawal that's paid directly from your IRA to your chosen qualified charity. The first step is ensuring you meet the qualified charitable distribution requirements. You must be at least 70 and a half to make a tax-free charitable contribution. Those who meet that requirement can transfer up to $100,000 each year from their IRA to a qualified charity without paying income taxes on that transaction. However, if you file a joint tax return, your spouse may also contribute as much as $100,000, which means a couple may exclude up to $200,000 of their retirement savings from their income taxes if they donate it to a qualified charity. If you contribute more than the maximum amount allowed, it will be viewed as income and will be subject to income taxes. Qualified charitable distributions must be made by December 31st each year for that amount to be excluded from your taxable income. The next factor to weigh in is that a qualified IRA charitable contributions meets the annual minimum distribution requirement for your IRA. Also, you may dictate part of your required distribution to charity and then withdraw the remainder as retirement if you meet the minimum distribution requirement before the year's end. If you're already making annual donations to charities and organizations you care about, why not consider making those donations out of your IRA with money you're required to take out anyway? Determining your qualified charitable distribution tax break is the next step you may want to contemplate. As the article explains, a $100,000 charitable contribution from your IRA may ultimately save you tens of thousands of dollars in taxes, depending on your tax rate. But you don't have to make a big donation to utilize this tax break. Here's an example. An older person in the 24% bracket who makes $5,000 charitable contribution may be able to shrink their tax bill by $1,200, and even a $1,000 donation may still save that same person $240 on their taxes. The possible tax benefit of charitable contributions from an IRA are even bigger the higher your tax bracket. Next, you may want to set up a direct transfer to the charity of your choice. This is another step a financial services professional could help you with. To qualify for the tax break, your money must be moved directly from your IRA to a qualified charity by the IRA trustee. If you take money out of your IRA and later choose to donate it, it won't qualify as a tax-free qualified charitable donation. Like so many other parts of your financial strategy, it all comes down to timing. In terms of choosing your qualified charity, it must be a 501c3 organization for it to accept your tax-free IRA charitable contributions. Organizations that don't qualify include private foundations and donor-advised funds. You can also distribute your required minimum distributions to more than one charity during the same year. For example, you may want to consider giving a portion of your donation to a local organization that provides food and assistance, and other portions of your donation to an art location that shares your values. Once you've found an organization that aligns with your values, you may want to evaluate it to ensure it's financially effective. Luckily, that's exactly the title of a ProPublica article titled "How to Evaluate a Nonprofit Before You Donate." As the article notes, not all nonprofits live up to their claims. Do you know how the organization you're considering supports spending its money? The ProPublica article points out that a nonprofit college spent more money on marketing than financial aid, and the Red Cross built just 6 homes after taking in money for a disaster relief in Haiti. As a donor, these kinds of things may give you pause. Fortunately, you can find out where an organization money goes. Organizations that take in more than $50,000 have to file a Form 990, which you can look up on ProPublica's Nonprofit Explorer tool. See how much that organization spends on executive compensation, professional fundraising, programming, and more. If you look at all of these things and you don't like what you see, you may want to choose another charity. Well, that's about all the time I have for this segment. If you'd like to talk about contributing to a charitable organization from your IRA, contact our office today at retirewithbushka.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Bushka Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Bushka Wealth Management and Bushka Retirement Solutions, and joining me today is Ryan Connor. Now today, Ryan and I are going to talk about the Tax Cuts and Jobs Act.
That's right. Now, certain provisions of the Tax Cuts and Jobs Act are expiring soon, and that may have an impact on you. The legislation included many tax reform benefits that are set to expire at the end of 2025.
That's true, and Investopedia covered the details in an article titled, "What is the Tax Cuts and Jobs Act, or TCJA?"
Now that sounds like a good place to start. Now, Cole, why don't you fill the audience in?
For sure. Now, the Tax Cuts and Jobs Act was a significant overhaul to the tax code. In fact, it was the largest tax reform in 30 years. President Trump signed the legislation into law, and it took effect in 2018.
So what was actually in the Tax Cuts and Jobs Act?
Well, the legislation established a 21% flat corporate tax rate. The corporate tax cut was permanent, but the bill included some temporary tax cuts for individuals as well.
And what were those tax cuts, Cole?
Well, here's where it gets a little bit complicated. First, the legislation changed several tax rates. The top tax rate went from 39.6% to 37%. The 33% bracket went down to 32%. The 28% bracket dropped to 24%. 25% bracket went to 22%. And the 15% bracket went down to 12%. Now, the lowest bracket stayed the same at 10%. There was also no change in the 35% bracket.
So if you're in one of those brackets, your taxes are going to go up after 2025.
That's right, unless Congress extends the tax cuts or makes some other change.
So now we're going to talk about what you can do if you are facing future tax hikes. But before we get to that, let's go over some other items in the Tax Cuts and Jobs Act.
The TCJA raised the standard deduction. For 2024, the standard deduction is currently $14,600 for individuals and $29,200 for married couples.
The TCJA also suspended the personal exemption through the end of 2025.
So what was the personal exemption, Ryan?
So the personal exemption was $4,150, and that deduction or exemption was available to all taxpayers. The TCJA got rid of it, but made up for it by somewhat increasing the standard deduction for both individual and married filers.
What about the individual mandate for the Affordable Care Act?
So when the ACA was initially passed, it included tax penalties for individuals who failed to purchase health insurance. The TCJA eliminated that mandate.
The TCJA also increased the child tax credit to $2,000 and created a $500 credit for non-child dependents. These changes also expire in 2025.
Now, what about the estate tax?
The TCJA raised the estate tax exemption. The maximum in 2024 is $13.61 million, and it expires after 2025.
So what does that mean? The maximum what exactly?
Well, it's the maximum amount of an estate that can be transferred to a beneficiary before the estate tax kicks in.
So if I have an estate worth $14 million, and let's say you're my beneficiary.
Sure.
You would then only have to pay taxes on $390,000 of that, is that right?
That is correct.
All right. So what happens when the tax cut expires? How much will people begin paying starting in 2026?
Well, the rate will revert to its pre-TCJA level, which was $5.49 million or $6.98 million adjusted for inflation.
So using that same $14 million estate as an example, I'd pay taxes on a little more than half of that beginning in 2026.
That's exactly right.
That is a quite substantial change.
It certainly is, Ryan. And if you have a sizable estate, you may want to keep a close eye on what happens with this legislation. If the exemption reverts to the pre-TCJA level, your beneficiaries could be hit with higher taxes when you pass away.
This sounds like a pretty big deal.
Absolutely it is. Meeting with a financial services professional may be a good idea if you're concerned about how these legislative changes could affect you and your beneficiaries.
Now, should our audience also think about reviewing their wills and trusts?
Absolutely, I think that's a great idea. If you have a will or if you have trusts set up, reviewing them periodically is a good thing to do anyways. But with these changes coming to the tax code, you may have even more of a reason to go over your documents again.
So should you go over those documents with a lawyer?
Well, if you can talk to a financial advisor about how the tax changes are going to impact your estate and then discuss that information with a lawyer who can create or amend your documents, I think that you may be in pretty good shape.
That makes sense to me, Cole. Have a team of professionals on your side who can help you achieve your goals. So what other parts of the TCJA are set to expire at the end of 2025?
Well, the TCJA lowered the mortgage interest deduction for married couples from $1 million to $750,000, and it will end in 2025. Additionally, the TCJA suspended some miscellaneous itemized deductions through 2025. Deductions for moving expenses were suspended.
So does that mean that after 2025, people will be able to deduct moving expenses again?
We'll see.
Cole, earlier in the segment, we talked about how the tax rates for most brackets are going to go up after 2025. So let's assume for the moment that the tax rates won't be extended. What can people do right now to protect themselves?
Well, first, you may want to take a look at what you could cut out of your budget.
But I don't want to do that.
Nobody does. It's not fun to think about cutting back, especially when it's for taxes.
So what else can people do?
Well, some people may have the option to prepay their taxes for future years at the current rate.
How do they go about doing that?
Well, if they're eligible, they may be able to prepay their taxes at the current rate using funds from a Roth IRA.
How do people know if they're eligible or not?
Well, their financial advisor or we can help them with that.
So call your financial advisor, or us, to future-proof your finances.
That's great. That should be an ad, really. Future-proof your finances with Bushka Retirement Solutions.
You heard it here first, folks.
Well, Ryan, we have a little bit of time left. What else should we cover?
Since we're talking about taxes, let's talk about tax-related scams. According to AARP, there are people out there who call pretending to be the IRS. They'll tell you that you owe the IRS money, that you have an unclaimed refund, that you have a tax rebate coming your way.
I bet it's scary for most people to hear that they owe the IRS money.
Absolutely.
So how do you know if it's a scam?
First of all, know that the IRS doesn't call you. They also don't send emails, text messages, or contact folks over social media. If the IRS has something to say to you, they will send it in the mail. They also are very unlikely to just show up at your door.
Does the IRS demand immediate payment?
No, and that's another sign that it's a scam. The IRS offers a multitude of installment plans and other solutions for people who owe tax payments. They're not going to turn the screws on you and force you to pay right there and then. Only scammers do that.
So what about payment methods? Would the IRS ever ask to be paid in gift cards?
Absolutely not. I would love to see the government try and balance its ledgers with Starbucks gift cards. They also won't take crypto or any prepaid debit cards.
So what should our viewers do if they get a call like this?
Number one, hang up. If someone shows at your door, shut the door. Don't worry about being polite to these people. They are trying to scam you. Do not open unsolicited emails. Avoid clicking on attachments. And finally, if you make payments to the IRS, make sure you're making them at irs.gov, not some sketchy third-party site.
That's all great advice. I think we're out of time though. If you have any questions about how tax increases may affect you, be sure to contact our office today at retirewithbushka.com or call us at 715-355-4445. We'll be right back with more of Financially Speaking after this.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. Now, this is the same way that we communicate to our clients when we meet with them in person. And remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. So call us at 715-355-4445 or go to retirewithbushka.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or to schedule that complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445. Or feel free to send us an email at info@retirewithbushka.com. Join us next week at the same time and the same place for another episode of Financially Speaking.